Welcome to Inside Economics. I'm Mark Sandy, the Chief Economist of Moody's Analytics, and I'm joined by my two co-hosts, Ryan Sweet. Ryan's the Director of Real-Time Economics, and Chris Dorides, the Deputy Chief Economist. Well, guys, I'm back in the U.S. of A., and I have to tell you, I'm very happy to be back.
Well, that was quite the voyage.
It was.
Yeah. Do you count up the number of miles you flew?
A lot of miles. I literally circumnavigated the globe. Yeah. I did.
Wow.
Yeah. And actually last night, I got back last Saturday. Last night was the first night that I actually slept 8 hours. You know, when I first got back, I was getting up at 3 a.m, then 4 a.m, then 5 a.m. Finally, 6 a.m, and I got 8 hours because I went to bed at 10. So.
See, Chris, he's laying the groundwork so he can say he's tired.
No, I actually feel very good. Right. I feel energized. I feel really. Today's Friday. That's a good thing too. So yeah.
But now that you're back in the U.S., trouble always follows you. So
it does.
Your recession odds must now have been higher now that you're back.
No, did you look at the stock market today? What's going on?
Oh,
lots of green.
Yeah, stock market.
It's funny how my mood. I'm telling you, my mood depends on whether I see red or green on the screen. Not you guys. You don't feel the same way? No, it doesn't. Oh, okay.
Try not to look.
Try not to look. Yeah. I'm
no,
looking
my
all
mood
the time. I'm literally looking all the time.
Yeah, you're looking at the stock market. If my kids are in a good mood, then I'm in a good mood. So
yeah, that's a good point.
That's the most important.
That's a good point. Yeah, I was at your age. I felt the same way. Well, it's good to be back, and we've got a guest, John Leer. John, good to have you.
Yeah, great to be with you today.
John always looks rested. Have you noticed that? He never looks tired. I don't think they work him hard enough over there at Morning Consult.
Ooh.
He's got a cushy job. I think he's got a really cushy job. That's my guess. Look at him.
Yeah. Just, a Midwestern charm and youthful spirit.
Hey, I didn't know you're from where in the Midwest are you from? I
grew up in Indiana, just north of Indianapolis.
Oh, you don't have any Midwest accent that I can discern.
Very neutral. Yeah, not. I don't have any of that sort of Wisconsin, Minnesota, Fargo style accent.
Nothing. Even Michigan.
Even Michigan, yeah.
Yeah, Michiganders have it. Yeah. Well, it's good to have you. So this is your second foray on Inside Economics. You came back. Thank you.
That's right. Yeah, I wasn't scared away.
Yep. And Ryan does that to people,
A lot of people.
Yeah.
A lot of people. And I wanted to ask you, because I think the last time you were on, you were building out your group, group of economists at Morning Consult. So, and I'd like to know how that's going, but maybe just briefly tell us about Morning Consult again. So for the listeners out there that didn't catch it last time you were on.
Sure. Yeah. So in a nutshell, Morning Consult is a global decision intelligence company. So we use daily global surveys to try to inform insights and actions. I'm the chief economist, so I focus on our economic intelligence, our economic data sets and analysis. We collect roughly 20,000 surveys every day across 44 countries on a range of economic indicators, and then release 3 monthly reports focused on spending, confidence, and employment and labor markets. So we're just sort of constantly in this cycle, really trying to find ways to integrate our data into existing data sets, understanding those relationships, figuring out how our data might shed light on some otherwise area of uncertainty or darkness. And we've got a team now of 6, soon to be 7, but we got 6 full-time right now. So that's really exciting. Scott Brave runs our economic analytics group. So he's doing a lot of the high frequency nowcasting and a lot of that sort of fairly technical forecasting work. And then he's got 2 folks underneath him, both from the board here, from the Fed board, who are building out a lot of the data analytics work with him. And then I've got 2 analysts, Kayla and Jesse, who do sort of sit in between, and they do a mixture of the writing and the narrative analysis, as well as some of the more technical forecasting work.
That sounds like a great team, and hard to build out in this kind of labor market, isn't it? Yeah.
Very challenging. It has taken, I think it's basically taken since we spoke last, basically a full year.
A year. Yeah. Wow. Wow. Well, it's good. You guys do great work. I mean, the
Thank you.
one thing that kind of highlights it for me is you run that daily survey of consumers where you ask essentially the same questions that the University of Michigan asks in their survey, but they do it, I think, twice a month, and it's 500 people, and
That's right.
you're doing it with tens of thousands of people, right?
Yep. So every day in the US, we've got 6,000 surveys that we're running, exact same 5 questions used by the University of Michigan. So it allows us to get that very high frequency pulse on the state of the consumer. How are they feeling? It also allows us to do a lot of demographic and geographic breakouts that become fairly challenging with 500 completes a month. And then we can do the real-time cross-country comparisons too, which right now is top of mind for a lot of folks considering how troubled the world is.
Yeah, I'm going to come back to that, the consumer surveys and what they're saying and how they vary across the globe. But before we do that, I'd like to just talk a little bit about the economic data that came out this last week, and if that's affected anybody's thinking about the economy's performance or where it's headed. And I think this last week is heavy on housing data. So I
Yep.
thought maybe Chris, you could give us a sense of that and what the data is saying about the housing market and perhaps the economy more broadly.
Sure. Yeah. So there are a number of series that came out this week. This is a housing week in terms of construction and sales. So the general theme is weakening all around. That's nothing new. Kind of like, at least following our script in terms of where we anticipated things to go here. Right. Mortgage rates remain high. So the MBA mortgage applications data came in light. It was down about 4.5%. Right. So clearly the refinance market is basically dried up, and what mortgages are being underwritten are primarily purchases. That follows or is aligned with the sales data that came out this week. Existing sales came in at 4.71 million. It's down from the previous number. So it's, again, indication of the weakening, higher rates making it very difficult for people to afford homes, and sales are coming in. And then on the construction side, we also saw signs of weakening. So building permits actually were flat relative to August. So this is data for September, about 1.56 million building permits between single and multifamily, roughly flat from what it was in August. But housing starts were down, and housing completions, I think, were roughly flat, maybe up a bit. So clearly on the housing start side, single family housing is coming in, and multifamily, although it's up, it's not up tremendously. All right, so it's holding its own, but it's not accelerating at this point. And completions, as we would expect, we did see some increase there, but quite modest as well.
Right before I got on this podcast, I was on with a group of economists that I think they called it an economic advisory panel for the New York Fed. And we talked through different issues. And someone on the panel brought up the dark irony of rising interest rates hurting housing supply. You mentioned housing starts declining.
Yep.
And of course, we need more supply to get rent growth down so that we can get housing cost inflation moderating, because that's right now probably the biggest contribution, at least to CPI, consumer price inflation, I think right now, is the accelerating cost of housing, which goes back to rents. Do you have a perspective on that? Any views on that? That kind of dark irony of that?
Yeah, I mean, it's a difficult situation. That's simply put. I think it continues to point towards the bluntness of the Fed's instruments. Monetary policy can't solve everything, right? And we actually do need more fiscal support or fiscal adjustments here, I guess, to compensate and address this. This is really fine tuning we're talking about here, right? We need more supply of housing, but we don't want to cause more inflation. All right. So you need some type of fine tuning that the Fed just can't handle with its tools.
Yeah, I made the point that it depends on how long these high mortgage rates prevail. I mean, because we do have a large number of homes in the pipeline under construction going to completion. In fact, I think it's still a record number. And, it's kind of piled up there because of the labor supply issues and the supply chain issues related to the pandemic. But now, with an easing of those supply chain issues, we're getting appliances and building materials now making their way here, and the labor supply issues starting to ease up a little bit, because of the weakening in job growth, hiring. Then that will allow these homes in the pipeline under construction to go to completion, and that should help with supply at least for a while, maybe 6, 9, 12 months. If rates remain elevated for much longer than that, then we got a big problem. We're going to see a big decline in supply coming to the marketplace. Would you agree with that kind of assessment?
Yeah, I would, and that's consistent with the data, right? The completions are up, but the starts are down, right? So, and the permits, which that's future building activity, I view that as the option, right? They're builders they do see these positive forces in terms of still lots of demand, demographically driven demand, especially, but the cost to build or cost of borrowing is preventative.
But isn't there an issue though with, one of the issues has been the baby boomers staying in their houses for longer. As home prices start to fall, all of a sudden they're more likely to hold on to their houses, less likely to move into the sort of, the smaller single floor ranch or something like that. So I guess I just wonder, we're continuing to see sort of the sellers drop out of the market to fewer older adults saying that they're interested in selling their homes. I wonder if that's sort of a dynamic at play in addition to the new home part of the equation of just higher input costs.
Yeah, absolutely. So there's a lock-in effect across the board, right? Especially with the lower rates that people have been able to lock in on top of that. So not only a preference perhaps to age in place and not downsize, as you mentioned, but even now the economics make it even less likely, right? Because they've locked in this 3% rate, and locking in a 7% rate is just not feasible for most people.
So John, you mentioned in your survey work, you're finding that potential sellers are pulling their homes off the market.
The share of home owners intent on selling their homes has consistently fallen for the last 8 or 9 months. It was at 15% in February of this year and down to 10% now. So, I mean, I think that's what we're trying to sort of understand is that mismatch between the supply and demand in addition to the new home part of the equation, which of course is important, just understanding this dynamic between potential sellers and potential buyers.
Yeah, it's an interesting dynamic. I'm sort of the narrative in my mind is because we've seen house prices decline here pretty sharply in a very short period. I mean, mortgage rates started to rise in the spring. House prices appear to have peaked in June nationwide, and they're coming in now pretty fast. And according to our house price data, more than half the metro areas across the country now are experiencing house price declines. And in places like California, Chris, what is it? What are price declines now in like San Francisco and
I believe it was around 8%.
Yeah, some pretty big declines.
So in a matter of months, right?
So it feels like sellers are actually capitulating. They're saying, "Oh, these mortgage rates are high. They're going to stay here for a while, high for a while. Oh, and by the way, there's a recession coming, so I better sell now. Otherwise, if I try to sell it 6, 9, 12 months from now, I'm going to sell it at a lower price." And you're seeing prices come down very rapidly.
But the volume of sales is down.
Yeah, that's true.
Right?
So that's consistent with the sellers taking their homes off the market.
Exactly.
To John's data.
Yeah.
I mean,
so we actually saw that months of supply actually rose.
Yeah.
Right. But that's a bit of a head fake, right? Inventories came down. It's just that we're selling at a slower pace, right?
So we often talk a lot about the new home market, but that's only 10% of all home sales.
Right.
Existing, that was John was referencing. That's the key part. And people are just not going to list their homes now.
Right. So let me, Ryan, since I heard your voice. So and that's rare. It took him this long for me to hear his voice. Generally I hear his voice, kind of immediately. But
Well, I was going to point out that you just said a recession is likely.
I said, they think recession is
Okay.
likely.
Well,
They
someone
think those sellers.
had a quote in CNBC.
That you take everything out of context. John, he does this all the time.
No,
Is that right?
Yeah,
Chris,
he reads the
is that out of
headline. He doesn't. He
context?
doesn't. Got to dig deep. We got to dig deep into the. But we'll come back to that. We're definitely coming back to probabilities of recession. But I was going to ask you a question. Oh, based on everything that's gone on this past week, all the economic data and everything else that's gone on, and a lot has gone on. Is your sense of how the economy is performing, where it's headed, changed at all, or are we still on track to that?
No, I think we're still on track. I think our
Yeah.
baseline forecast is still roughly right, that the economy is clearly slowed, and next year is going to be even more difficult. But we got a lot of housing data this week. We got industrial production, which actually came in a little bit better than I anticipated, so that was
Yeah.
encouraging.
Mm-hmm.
I think the parts of the economy that we would expect to weaken by higher interest rates, a stronger dollar, so manufacturing, housing, that's all kind of playing out to script. It's whether or not, and this is why it's great to have John on, can the consumer hold on? And if they do, then we can skirt a recession. But
Whoa.
nothing really this week changed my outlook.
Well, what did he just say? We could skirt a recession? Didn't he just say that?
That's our baseline forecast.
Yeah. So
Yours.
You think we
Your
can still
baseline.
skirt a recession? No, you're.
I didn't say
saying,
I think we can.
Oh,
I said
that's the
our
baseline.
baseline.
Well,
yeah,
It's
means-
possible, is what you're saying.
anything's possible.
It reminds me a little bit. I grew up caddying, and people would always ask me if it's going to rain, and the caddy master's answer was always eventually.
Yeah.
And I think right. So, are we going to skirt a recession? Will there be a recession
point.
eventually? Yes.
Yeah, eventually there will be.
Yeah. I have a lot in common with you, John. I caddied too. Yeah.
Did you really?
I did indeed. That was like that was a great job, I thought.
Great job.
Yeah.
Really, really bad.
Hard. Did you double bag kind of?
Eventually, I started when the bag was bigger than me, so it took me a couple of years to grow into the phase where I could carry a bag. But it was great. I got a partial college scholarship out of it, and
Oh, you must have been
learned
a
a
good
lot.
caddy. Jeez, you
It
must have
was-
been a great caddy.
This almost sounds like the movie Caddyshack.
a little bit. It was a
Yeah.
little bit like that. There were some characters.
Yeah. Well, you know what, John? I know you watch the economy very carefully from your prism, and just to level set, Ryan is very bearish on the economy. What 70% probability of recession in the next 12 months?
75 mark.
75.
Oh,
Chris
bumped it up.
is
He
also
bumped
bearish, not quite as bearish. Are you 70%, Chris?
I'm 70. I'll stick with 70.
70, and I'm at 55% over the next 12 months. Not as bearish.
I think I would split the difference probably, and I would say a lot of it, oddly enough, is from all the data that we're collecting really over the last 2 weeks. It has just consistently come in lower than I would have expected. We have this, Scott Brave and Kayla built what they call the Consumer Purchasing Power Barometer, and just really starting to see instances of middle and high income consumers walking away from a pretty wide range of purchases due to higher than expected prices. And it's been a really strong indicator thus far, leading indicator of real PCE. And so I think, it's hard to say, but I think the first quarter of 2023 is going to be marginally negative. And then it's a question of what that second quarter will look like. I think it's going to be really, really close.
Well, Q3, just and into Q3, that's going to be positive, right? We're tracking
Around
GDP,
2%.
2%.
Yeah.
So,
So
John,
did I misspeak? I'm talking about the first quarter of 2023.
no, I know, but so
yeah.
what do you think about Q4? You think Q4? No
I
strong views.
bet it'll be point something.
Okay.
Mhm.
Okay.
Point something, either point something positive or negative, but it
Okay.
looks to me like it'll be almost flat.
So you're thinking reset. So what's the probability?
I would
of
put it.
recession?
I'd put it closer to 60%.
Okay, and you're thinking
65% in the first half of 2023.
first half of 2023. Okay,
Yeah, that
and
Q3 number, that GDP number, just like the first half of the year, it needs another asterisk, because if you take out trade, net exports, we're tracking 0.4% annualized, which is very, very weak. Like inventories and net exports caused those declines in the first half of the year. Now that's adding to the second or Q3. But if you strip out the weakness in the GDP data, is becoming more prevalent.
yeah, well, it feels like if you strip out the net exports, since this time last year, GDP has basically been flat.
Yeah, we're moving sideways.
We're moving sideways on GDP.
Yep.
On jobs, still lots of jobs.
Mhm.
Yeah.
Right. In fact, we got another strong data point there on UI claim, initial claims for unemployment insurance, which is a window into layoffs. They're very low. Just
I'm
over
puzzled by
200.
that.
Huh?
I was surprised because I thought the
Yeah.
hurricane
Right.
was going to juice
Yeah.
Florida, and they fell in Florida. So
Right. Right. So, okay, which indicates that the labor market's still strong,
mhm.
right? And not at all consistent with the idea that we're certainly not in recession, and recession is not imminent. And I'm not saying you guys think that. You're also a first half recession kind of guy too, aren't you, Chris and Ryan? First half 23. That's when you think the recession will hit.
Although probably more second quarter versus first.
Yeah.
Okay, that's splitting hairs, but okay.
Well,
But fair
give
enough.
me a little
Yeah.
color, a little insight.
All right.
Chris,
Very
you
good.
got to give a month, a day, an hour.
Yeah.
Yeah.
So, John, one indicator that I look at for gauging recession, whether it's imminent or not, is the change in consumer confidence.
Yep.
Not so much the level.
Right.
Right now, we know everyone's very pessimistic and dark. They've been that way for a while since the pandemic hit, more or less. But it's really when it changes to the downside in a very significant way, because that indicates that consumers are losing faith, I think, that they're going to hold on to their job and they go, oh my gosh, and they stop spending. And that's recession. When the consumer packs it in, we go in. And in fact, I'm sorry, this might be the competition, but I look at the conference board survey, the monthly survey, and if by looking historically, if that survey, the index, falls by more than 20 points in a 3-month period, we're in recession 6 months later on average. It takes about 6 months for that to happen. That's not happened so far. The last data point we got from the conference board was actually not bad. It actually improved a little bit. And over the past 3 months, it's basically flat. So that indicates if history holds and that relationship holds, no recession certainly into next year. Does that resonate with you, that kind of frame?
I mean, certainly it's the case that it's the change in confidence that matters. And you see that really clearly if you start doing, demographic breakouts or country comparisons. Looking at difference in levels doesn't tell you a whole lot. But, for us, what we've been tracking for a while is this sort of ongoing divergence between what we've seen in confidence, which has fallen precipitously this year, roughly 15-20% this year. And then the actual spending data, it's held up remarkably well. When you go back and look at the updated national accounts data, it looks even better, I think, in hindsight. The first half of the year was pretty strong. And so there's something going on there. I think that is largely this really, really strong jobs market and a robust war chest of savings. We're starting to see that savings dwindle pretty rapidly. And then there's sort of a question of whether or not the income stream that consumers are benefiting from in the form of wages will dry up. What I can tell you most recently is that confidence is yet again falling, despite the fact that gas prices have kind of leveled out. They're increasing a little bit, but it's a pretty dramatic difference from, let's say, what we saw over the course of the summer, where this rise in gas prices was very, very strongly correlated with the fall in confidence.
Oh, interesting. So is this the questions that are similar to the University of Michigan survey?
Yeah.
Okay. So that daily survey that you do, you're saying recently, last couple, 3 weeks is
3 weeks was the other turning point. Yeah.
And is that broad based across all demographics, high income, low income?
Basically, and what I've been watching really closely is older adults. It feels like they kind of get how inflation is likely to play out and affect their finances in a way that younger adults don't. And so older adults in many ways have been a sort of a leading indicator of the broader consumer sentiment over the course of the last 12 months. And older adults have become noticeably more pessimistic about the economy in the last 3 weeks. And we're starting to see that essentially sort of trickle down like a waterfall effect to hit other age groups.
Oh, that's interesting. So your data would be consistent with this frame of falling consumer confidence leads by a few months, and this weakening you're seeing right now would be, if it continues, would be consistent with the forecast that you made that we're going to experience some negative numbers in the first half of 2023.
I think that's right. Yeah. Although I should add, and maybe it's surprising, but you mentioned the Commerce Board. They have a lot more focus on labor market outcomes. We track, whether or not employed adults expect to lose income. That number has continued to fall. So among people who are working, it's really something like 9% expect to, have some sort of pay loss, which is down from 12, 13, 14% earlier this year. So the people who have their jobs are really, really feeling great about it. And there's a question of what sort of shock might happen, I think, that could dislodge those folks.
Yeah, could it be the case that this recent weakness you're seeing, particularly among older Americans, is related to the weakness in the equity market? I mean, we saw a pretty sharp decline.
Yeah.
Okay.
Also very possible.
Yeah. Okay. Okay. Interesting. All right. So you're pretty pessimistic as well. Not as dark as these two other guys, but pretty pessimistic. But if your forecast is correct, it sounds like we need to continue to see further weakening in sentiment here, which will ultimately have to show up in spending.
That's right.
Okay. All right. Let's do this. Let's play the game, the statistics game. I think this is a good place to play it before we go back to some of the other work, John, that you're doing, survey work that we want to talk about. The game, as most listeners know, is we each put forward a statistic. The rest of us tries to figure that out through questions, clues, deductive reasoning. The best statistic is one that is not so easy. We get it quickly, not so hard that we never get it. And it would be nice if it's apropos to the topic at hand. But I'll warn you guys, mine has nothing to do with anything. So here, it's going to be a little tough. I'll give you a few hints.
Did it come out this week?
It did indeed.
Okay.
Yeah.
Right.
And I'm not sure if I answered that question the way I answered it will help you or hurt you, but in your quest. But it is relevant in that sense. It's timely. Let's put it that way. It's a timely statistic.
All right.
Okay. All right. Who wants to go first? Ryan, you want to go first? Yeah.
No, let Chris go first. A lot of
Chris
housing
go first.
data.
Okay, Chris, you go first.
All right.
And I have a feling this is a housing statistic.
It's got to be.
Let me guess what it is already before you even say it.
All right.
No, only kidding.
Here's
Go
my
ahead.
hint. It could be a housing statistic, but it's another statistic that if you get this, multiple
I'm a god.
This is,
I'm a god. I'm a statistics god if I get this.
This is
If Mark gets
very
this, then there's
esoteric.
collusion.
No collusion. There is no collusion.
The number is,
Prove that.
my number is 35.
35.
Yeah.
Okay.
Is this buyer traffic from the NAHB?
Oh, well, that would be the housing over what period?
What?
Next 6 months?
Next 6 months. That would be the legitimate 35 to guess. So I'll give you the cowbell for that. But,
No, wait a
whatever.
second. But that wasn't your statistic.
But well,
There's another
not, but it's
35 out
Okay,
there.
that's not
That's also-
fair.
that's
That's
also
not fair.
Hey, there's
You know,
another 35 out there.
all right, take
There's
it
another-
back. What?
You can't give him a cowbell for a statistic he just made up, even though
make
it's
it up.
35.
It's
What?
also
Wait.
35. I said it. I said it. There was also a 35 that was housing related, and that's the one. So,
Oh, I see. I missed
so
it.
I think
So
it's
Okay,
this
it's
is another
cowbell.
35.
Report the
Cowbell.
units.
the
There's no
35
unit-
I want to talk
no-
about is different.
No units required when you play
Well,
this game. Just-
if you need the units, John, I mean that
Okay.
come on. If you need the units, we'll give you the units.
Is this a percent?
No.
Is it a statistic that came out this week?
Yes, it was reported in a Wall Street Journal article.
Oh my
Oh,
good
wow.
God.
It is a statistic. It comes from a legitimate agency, but
So we don't
agency.
cover this on
no.
Economic View.
No.
Is it housing related?
No.
Oh,
What? Is it one of your like random survey? Thing?
is it survey based?
Nope. Would you
No.
like the units?
Yes,
Yes.
please. Yes, John said yes.
35 ships.
Oh, is that the
Chips?
number?
Did you say
35
chips or ships?
Ships, boats, large.
Boats.
Vessels.
Yeah. Is that the
Is that
number?
the number of boats parked off Port of Long Beach?
Nope. No, that's
Uh,
actually down. I heard that's down to nothing now. It's
But that maybe they're just managing it. They're all out
Yeah,
in the Pacific.
it could be, but
Is that the
it's not that.
number of ships in Shanghai port?
Nope. You're getting further.
Oh, further. Hmm.
This is.
Wow.
I promise it has relevancy.
No, it's got to. Is it related to supply chain
Yeah.
issues?
Not particularly.
Oh, okay.
Is it ships parked somewhere?
It is ships.
Somewhere.
Russian energy ships.
Oh,
oil
energy.
Oh.
You're on it.
Oh,
It's the okay.
go ahead.
It's there
I
are
get it.
35 ships that LNG ships
Oh,
that are parked off the coast of Europe,
we should have
waiting
known
to
that.
unload.
That's a lot of ships.
It's
It
a lot
sounds
of
like.
ships. They are so they're not unloading the gas that they have because so far the weather has been mild in Europe.
Oh,
So they're not drawing down, and then they're at capacity. Storage is maxed out, so they are.
Isn't that
They're,
interesting?
but they're waiting there because they expect that prices are going to rise. So it's still in their interest to wait. So my optimistic view is that
that's
that
encouraging.
actually could help us in terms of keeping energy prices down, right?
No, you saw a big
Right.
drop in UK utility prices recently.
Exactly. Oh, and in the EU or in
EU,
Europe
yeah.
overall.
Because of this or something else?
Well, I think it's a mix, right?
Mix
It's,
of things. Yeah.
Right. The demand. So the other factor is China, which we, of course, now we don't know what's going on there. So they're not releasing GDP
Oh, yeah, how about
stats. But
that? Right.
if there's weakness there, right, that's lowering demand potentially. So there's that. And then the supply certainly is encouraging as well.
Yeah, that's a really good statistic.
I thought so.
Yeah. I mean, impossible for us to get.
Yeah, absolutely.
But nonetheless,
Yeah.
very interesting. And they're at capacity right now in terms of their LNG storage.
Or very close to it. They actually they don't have capacity to unload more ships at
Yeesh.
this point.
I
so.
see. Well, that may
According to the
explain
article.
why natural gas prices here in the U.S. are also down, right? Because we're back down to like $5 per million BTU. We were almost double that, I think, back.
Yeah, we're close to
Come
10, right?
Yeah, so that's also encouraging for us in prices here. I also noticed that storage or inventory of natural gas is pretty strong here as well. It's been surprising to the upside. So I guess that's all consistent. Oh, that may go to exports are down from the U.S. as well, right? So that
Right.
it all fits. Okay.
Yeah.
Ah,
Oh.
the dots
good
are being
number.
connected
Yeah.
in my mind. See how that works? Yeah.
So it could help. It could
Yeah, it
certainly
could
help
help.
the inflation picture here.
Yeah. Okay. Very good. Okay, that was a good one. Hard, but good one. John, you want to go next?
I'll go. I should say, I'll preface this by saying the last time I was here, I think Ryan guessed this in like two seconds. So I have dramatically changed the scale
Oh no.
and
You're
moved to
shell-shocked.
a slightly more arcane, less well-known statistic. So this is the statistic is 0. I'll give you the units too. It's 0.9 percentage points.
That's the statistic. 0.9 percentage points.
Came out this week.
Came out this week.
Is it something that you guys?
It's not
create?
nope.
Okay.
Publicly available, government released.
Is it
0.9.
Related to industrial production? Nope.
It's not.
And housing?
No, it is related very closely to something that is near and dear to what I'm working on.
Inflation expectations?
No.
He paused. Did you notice that?
That's a
He
good guess.
hesitated.
No, sorry.
Yeah.
Sorry, that was a head fake.
But related to consumer spending in some way?
No,
No.
Wages, incomes,
closer.
closer.
Oh, is this median usual weekly earning? Or what was it?
Closer. You got the
Wages.
agency correct.
BLS, Bureau of Labor Statistics. Okay. What else came out from the BLS this week? I'm not sure. Is it wage related? Labor market related?
Labor market related.
Oh, is this
Is that that
the
ratio or-
insured unemployment rate?
No, that's
No.
no.
That's
no.
1%.
Is it 1%? I thought it was.
It's regional data. So you've got to pull things back a little bit and dive in a little deeper.
Wait, did this come out today?
Oh,
The
this
state
morning, regional and
employment-
state unemployment.
This week. There we go. Chris is starting to think.
That was this
Ah.
morning, though, right? No.
Wait, are you going?
Oh, is that the
lo-
unemployment rate in Iowa?
We're
Indiana.
you gotta
Indiana.
so pick a state.
Indiana?
Indiana.
Well, this is the I'm not gonna give it to you.
No,
This-
no, no, no. Is
No,
it a
no, no.
state? No, this
It's
is
a
fun.
state, not
We're
it's
just
a
gonna
state,
name
not
all
Indiana.
50
We're just
states.
going to name all 50 states,
Right.
all in the Midwest,
It's the state-
Nebraska.
It's the highest. It was of the month over. It's a month over month change, and this was
Oh.
the highest month over month change.
Oh, you go.
Um,
This is hard.
Yeah.
So it's the largest increase in the state unemployment rate.
in not an unemployment rate.
Oh,
Oh, I think we should give up. this is getting
yeah.
embarrassing.
This is
It's embarrassing. Ryan's getting embarrassed. Look at him.
Yep.
We got a 2-month lag on this. So today or yesterday, they released the state level quits rates.
Oh,
Oh,
wow.
Oh,
That is
wow.
digging deep.
Oh,
Yeah.
So that is the value for Oklahoma, which had the highest month over month increase in state level quits, but that's for August. And the only reason I know that is because we're doing a lot of state level analysis of whether or not employed people are actively applying for other jobs. So we track on that same consumer confidence survey, we track whether or not employed workers are actively applying for other positions and trying to figure out what sort of dynamics we can identify at the state and MSA level.
So,
I think John gets it. That is probably the most difficult statistics that we've ever had.
Well, again, I should come on. I think last time, Ryan, I don't even think I mentioned it. I think I had said,
No, that one was
I
good.
just
That was
started
good.
and you guessed the thing right away. So, okay, these guys are pros. Let's come in and be a little bit more prepared.
So, but in general, quit rates are they're elevated, they're high.
They're
but
high.
coming down.
Apparently, I don't know. I'm skeptical of that. So
Really?
Well, the reason I say that is because LinkedIn came out today with an indication that their proxy for quits is back up. The national number that we track has started to trend higher again. So the quits number is for September, I believe, right? Is the most recent data that we have. So you're right that September things fell. I'm skeptical that trend is going to hold.
Oh, well, that'd be a problem, actually, right? Because quits are tied to wage growth. Wage growth is tied to inflation. That's tied to what the Fed's going to do or not do. So if quits start moving back up again, that doesn't feel right to me. But wow.
But you're right, though. Like to forecast the employment cost index, which is our
Yeah.
preferred measure of just use the quits rate, it does a really good job.
Yeah, that would be disappointing.
Mhm.
Okay. All right. Well, that really tested us, I'll have to say, John. That was tough.
Yeah.
That was tough. Oklahoma,
Oklahoma.
change in
Yeah.
the
Right.
quit rate
That's
in
right.
Oklahoma in August. Okay.
Right.
Okay. All right.
Preliminary too, but that'll be
Oh,
revised.
preliminary. Seasonally adjusted or unadjusted, John?
Seasonally adjusted.
Oh, okay. I thought you were going to give us the unadjusted change. Yeah. So.
Yeah, now 35 ships off the coast of your
Yeah, now that
Yeah,
feels
now,
right.
on a
That's
relative
easy.
basis, that's
Not
pretty
yeah.
nice.
Ryan, show us how this is done. Give us a statistic that we have some reasonable probability of getting. Go ahead.
All right. Minus 86% year over year.
Minus 86%
Mhm.
year over year.
All right. I'll give you a hint.
Okay.
So if you look at the level, it's the lowest since the late 1990s, early 2000s.
Released this week?
1990s, early
Came out this
2000s.
week.
Down 86%. It's an economic statistic that came out this week?
Yes.
Economic statistic.
Mhm.
Okay. It's not a financial market variable or, yeah.
Mm-mm.
Commodity.
Chris,
Is it
you should
labor
know this.
Is it
I should know
housing
this.
related?
It's housing related.
Yeah. Okay.
Gets
Is
also
that
tied in
something
with the
around the
consumer.
inventories? Inventories?
It's not inventory.
No.
It's not mortgage, purchase mortgage.
Ooh, you're getting close, Chris.
refi.
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 Sorry, that's what I
Oh,
meant.
okay.
Oh,
Yeah.
Refis
Well, who
are
gets the
down-
cowbell?
Yeah.
Yep. Refis are down 86% year over year.
Yeah.
And that index is the lowest since so if you look at the refi index itself. It's the lowest since the late 1990s, early 2000s. So
Yeah.
it ties us back into the housing related data, but also consumers. I mean, they're not,
Yeah.
homeowners aren't refinancing because of higher mortgage rates. So
Yeah.
Well, let me reverse the game on you. What do you think the average interest rate is across all mortgage loans outstanding? If you take all the loans out there, look at their mortgage rate, take an average. What do you think it is right now?
3.8.
Pretty close. 3.5%. So okay, you're 3.5, and the current mortgage rate is well over 7, isn't it, on a 30-year fixed?
Mhm.
So you can't.
You're locked in.
Well,
There's
yeah.
no-
The only reason you would do it is you desperately need the cash, right?
Right.
So-called cash out refi, but you'd have to be pretty desperate to do that because that'd be pretty expensive to do.
Exactly.
Yeah, interesting.
All right,
All right.
you want a number that's more difficult than John's?
More difficult than the change in the quit rate in
Yeah.
August in Oklahoma,
Yeah,
seasonally adjusted.
and I won't
Harder
let you
than
guys
that?
suffer too long. Yeah, 13.
13. Are you really want us to try to figure this out?
Just take one shot. And there's a number of references. I'll give you a very easy clue.
Beige book.
Yes,
Oh, way to go.
there's no data in the beige book, but you can.
References to recession?
Yes, there was 13
13.
references to recession in the latest beige book. 0 in January.
And these are comments that the Fed collects from businesses and the
Mhm.
district bank areas. And
Exactly.
they're
So
hearing the
there's-
word recession now.
Yep. You're starting to see more signs and references to recession. So
And this goes to John's point about consumers starting to
Mhm.
lose their nerve because they're thinking recession too.
all right,
Interesting.
Mark, let's hear yours.
Okay. Mine might be a little hard too, but this Ryan, you should get this one because it's something that we've been talking about. 4.97%. 4.97.
Oh, is that the terminal Fed funds rate that markets are?
That's a good. No, that could
I think that
be,
is also
but
4.97.
I don't think is that high. 4.97.
Yes, I think it's close to 5 now.
Oh, okay. No, that's the wrong 4. I see, Chris. I do not award a cowbell to that because that's not the 4.97.
Do you
John,
even have your
it-
cowbell next
It
do.
is 4.97.
All right.
I got my
All right,
cowbell.
ready to go.
This is
All
from
right.
VJ.
So is this a financial market variable?
It is indeed.
Okay.
It is indeed, and it's a daily data point.
Inflation
Well-
expectations, one of your
Nope.
Alright.
Nope. Bond market
Type of
related.
spread.
Spread. Very
high
good.
yield corporate bond spread,
Yeah, high yield
Yeah.
corporate bond spread. Yeah, 497.
which is very puzzling.
That's 497 basis points, 4.97. That's the difference between the interest rate on a so-called high-yield corporate bond. These are bonds issued by corporations of lower quality, below investment grade, relative to the 10-year Treasury yield, the risk-free rate. So, on average, historically, that spread has been almost on the nose, 500 basis points, 5%. And I'm taking it all the way back to when the junk bond market was put on the planet in the late 90s by Michael Milken, 500 basis points. So we're exactly within a basis point equal to the long run average. Now, historically, that spread will rise when the economy is under a lot of stress and recession is a real threat, right? Because investors think, oh, we're going into recession, businesses are going to start losing money, they're not going to be able to pay back their debt, therefore you got to pay me a higher interest rate to buy that bond to compensate for that risk, that default risk, that credit risk. But you don't see any of that in the data right now. None, zero. So how do you explain that? Except for it's not consistent with the idea we're going into recession, at least not anytime soon. How else would you explain that?
What's
Right?
what's the typical lead time?
It tends to start rising 6 months before, but from very low levels, and then once it blows through that average 500, that's about the time, a month or two later you're in recession. But the trajectory is straight up, straight up, because defaults start to mount pretty quickly, but you just don't see it in the data. Yeah. Do you have any?
Yeah, I think we
know
talked
you've looked
about-
into this.
Yeah, I mean, at least historically, you can, the high yield corporate bond spread is very closely tracks the VIX. So if you run a regression, you just model high yield corporate bond spread off the VIX would say that the high yield corporate bond spread should be closer to 700, 800 basis points now versus 500.
Right.
And you see that relationship is pretty tight, historically. And it's broken down since the financial or the pandemic. And I think our last podcast, I think we had Aaron Klein from Brookings on, and him and I think we're on board with the idea that there's moral hazard that, central banks have gotten involved in the high yield corporate bond market or the corporate bond market. Bank of England next week is going to start buying corporate debt again. So maybe that is kind of causing this relationship to break down, but spreads should be a lot wider than they are right now.
Yeah, I mean, I hear you about the moral hazard. That doesn't feel right. I think, put yourself, I'm an investor. I buy investor in fixed income, corporate debt. Do you think that you really attach a high probability that the Fed's going to bail you out?
I think
It has to be a
there's one
crisis.
factor.
It has to be like a pandemic shutdown before they would step in, right? No.
But corporate profit margins are wide. Perceptions of credit risk are low. I mean, if you look at the Moody's default forecast, it's still it's going to rise. It's going to normalize a little bit, but I think they're forecasting 2 to 3% next year. So I think that's also helping keep spreads tighter relative to where bond market volatility.
But that's
or
my
stock
point.
market.
That's my point. Maybe the economy is, you guys are too pessimistic, right? I mean, no. I mean, you
just being realistic.
But the bond market is saying, at least in this case, this statistic, if you take it at face value, maybe there's other technical factors going on. Who knows? But it had to be pretty whopping big technical factor to wash out the message there. I don't know. I find that interesting.
Yeah, no, it's fascinating. We've been doing a lot of, work in this and trying to kind of date where we are in the credit cycle and everything. And things seem to be tightening, but they're not, tightening so quickly that it would be a recession.
Right.
So,
okay. All right. Okay.
You see, John, that's what he does. He cherry picks.
No,
he looks for
I mean,
one number out there that supports his non-recession.
Okay, wait a second. I have 4 indicators I'm looking at for recession. One is the policy yield curve, difference between the 10-year and the Fed funds rate. That has to invert. The funds rate has to go over the 10-year. I don't know if you've noticed, but the 10-year keeps moving north, and it's now over 100 basis points, a full percentage point above the current funds rate target. So that's not consistent with recession.
Got pretty close earlier this week, though, right?
What's that?
You did see a narrowing between the 10-year and the 3-month earlier this week.
I said the funds rate. I said the funds rate.
And don't forget
the funds rate. The funds rate. I'm just saying.
These podcasts are recorded, Mark, so we can go back.
I'm just saying.
You've mentioned yield curves. You've said the 10-2, the 10-3, the goalposts.
I've got 4 indicators. The second one is the change in consumer confidence. That's still not signaling anything yet. No, what John said did my hair. What 3 hairs I have on my head did stand up when he said it, so I'm paying attention. Third is the high yield corporate bond spread. It doesn't feel like that's saying recession dead ahead. And of course, the unemployment rate, which doesn't give you any lead if that's rising, but that rises more than half a point year over year, you're in recession. But right now, that's 3.5%, and given the UI claims, doesn't feel like that's going to be rising here anytime soon. So those are the indicators that historically they would be saying if we're going into recession first half of next year, that they got to be tripping wires here pretty soon, right? No?
I guess my only pushback there would be, to say historically, when's the last time that we had 8% inflation? I think it's a little challenging to figure out how this is all going to play out when the dynamics are so unique to this particular experience. I mean, that's maybe what people say about every recession, but you almost need to go look, I think, at emerging markets or places that have experienced fairly rapidly rising energy cost and inflation and figure out how that sort of plays its way through the economy.
Oh, that's interesting. So you're saying my indicators are sending false signals because of they're skewed by or biased by the current environment.
I mean, I think we all have in the back of our mind the financial crisis, credit conditions, hyper focused on how that might, how a lack of liquidity might play its way through. That doesn't feel like that's the case right now. It's probably not housing. So what's the mental model for thinking about this particular recession? And then how should we adapt our interpretation of a lot of the different indicators?
That's a good point. That's a good point. In talking about that the kind of the what's going on in people's minds, let's go back to your survey work on consumer uh, inflation expectations,
Yeah.
because it, my sense is that if it, that's going to really determine to a significant degree fundamentally how things play out here. If consumer, so of course, inflation expectations jumped first with the pandemic, and then got pushed up much higher because of the Russian invasion and the spike in oil prices and other agricultural goods prices. And that increase in inflation expectations, first of all, sent the Fed on high alert and caused them to really pivot and start raising rates. But it also goes to the kind of surge in wage growth that was out of bounds relative to kind of our traditional measures of labor market slack, like unemployment, like the employment to population ratio. And so to get wage growth back in and to something consistent with the Fed's a more normalized level rate of inflation, 2% inflation, those inflation expectations have to come back down. They have to normalize, and it feels like, and I'm going to characterize the data and then turn to you and say if I got it right.
Yeah.
That it feels like it's starting to move in the right direction. Expectations of inflation are coming in, but they're still very elevated. Is that right, based on your
Yeah, in
survey?
the US, I think that's right. So I should say, we've taken a unique approach to measuring inflation expectations. We call it the indirect consumer inflation expectations. It's a collaboration with researchers from the Cleveland Fed and Brandeis University. And so what we do is we ask people, how much would your incomes have to change to make you equally well off for the changes in the prices of the goods and services that you buy? And so it's really tying together this concept of wage growth and price growth. And what we have seen, so we measure in the US 20,000, we do 20,000 respondents per week. And then on a monthly basis, we do, I think we're now at 20 countries and we do 1,000 responses per month. And so just this past week, we've seen a moderate decrease. So now I think we've got on the level front, we're at like 7.01% for the 12 month ahead inflation expectation. So it's a little high on the level front, but the trend has dramatically fallen from where we were in the middle of July. I think what's interesting is it's not a clear decrease. It's like the turning points are much higher now than it was during that earlier period over the summer, where just every month things got higher and higher and higher. Now we see it's down 1 week, it's up another week, it's down 1 week. It feels like consumers really don't know what to make of all this, because you've got high levels of prices, but also concerns, right, that maybe we're going to go into a recession, maybe prices, that would sort of suck some of the wind out of these price increases. At the same time, I think I was talking about this earlier, they were previously very strongly driven by gas prices. We're seeing that relationship dissolve a little bit. And then maybe the last thing, not to sort of totally go off topic, but we just published this today with the Cleveland Fed, so I think it's probably interesting, which is we ran a flash survey in the UK, trying to figure out if all this sort of uncertainty in political and economic uncertainty, how that was affecting inflation expectations there, and saw pretty dramatic increase, particularly among people who followed politics very, very closely. And so I think so that's maybe the high level piece. These are all 12-month ahead inflation expectations.
Can I ask why 12 months? Why not longer term?
Well, we also have the 5-year number too,
okay.
where that was added after the fact. So we've got, I think, now only maybe 3 months of that data. But what's been interesting is we just don't see they're very, very strongly correlated. You see people who have higher 12-month inflation expectations in general tend to also have higher 5-year inflation expectations, which is a little different than what the New York Fed reports. They sort of see the way that they are asking consumers, there's a greater difference, I think, between those two measures.
So the 1 year ahead inflation expectations is 7%.
That's right.
Which obviously is pretty elevated.
Pretty elevated.
Of course, the current inflation rate, CPI, consumer price inflation, is a little over 8. So that's obviously influencing that thinking. But is it what's the peak in that?
I think the peak was, we saw it at the third week of June. I think it was just shy of 8%.
Oh,
I
so
don't
it's
think
only come down a point.
it never breached 8%. Yeah. But it was at, let's say 3% in February of 2022. I mean, the summer it was this, I mean, every week you could just feel it building. And then the other point I was mentioning is that while we've seen this decrease in the measure of central tendency, the average that we report, the distribution of the respondents has fairly dramatically changed, with a much higher share at the end of the tail. So you've got more people who think that inflation is going to be something like 10% or higher, which is a little concerning. It's hard to, and that's, I think, the challenge with inflation expectations is figuring out how to make sense of it with a single number when the distribution might be evolving as well.
Any difference across demographic, age,
really
income?
strong, really strong differences.
Okay.
Like here again, similar to confidence, you see older adults much more likely to have higher inflation expectations. They've been more responsive to changes in prices as well. It looks like younger adults, they just don't update their inflation expectations as quickly from week to week. We see geographic divergences. In general, consumers living in metro areas that have elevated inflation also have higher inflation expectations. The same is true globally. I think it's consistent with some of that finding that, people who know that inflation is a really big problem, all of a sudden they start tracking prices very, very closely. And it's a luxury essentially to be able to not have to worry about inflation and live your life and make your saving and spending plans in a world of 2% inflation, where it doesn't change the cost of bread.
Have you looked at to see if like food prices are a key contributor to short run inflation expectations? Because they are, at least in the University of Michigan. It's food prices, it's gas prices.
I'd have to go look. I think what we've seen food prices globally. I just don't think that we have enough variation at the monthly frequency with food prices to start understanding what it means at the weekly level for inflation expectations.
Do you see any?
Go ahead.
Do you see any difference by education? The New York Fed shows.
We do see pretty strong differences. Yeah, pretty strong differences. With higher educated people in general have higher inflation expectations. Gender matters a lot. Males tend to have higher inflation expectations.
Is that right?
That's interesting.
Yeah, I wonder why that's the case. That's interesting. Huh.
And so, yeah, there's a lot of, we're doing a lot. We've got partnerships with a few other companies to dive into the data and really understand sort of how these changes might be impacting.
You mentioned you did a flash survey in the UK. Are you doing this same kind of survey in other parts of the world? Are you seeing the same dynamics everywhere?
Well, slightly different dynamics. I think a surprising finding was in Russia. Following the invasion, we had a momentary increase in inflation expectations, and then it came down and it remained shockingly stable. That's consistent with what we've seen in our confidence data. And
do you believe anything, any survey you get out of Russia, though? I mean, if I were Jesus, I'd be so nervous to answer it. I'd be scared.
Well, we're not asking them about their views on Putin. And what we have seen actually since as soon as he announced the conscription, we've seen a pretty strong and consistent decrease in
oh, really? Okay. Okay, so people are responding to it. Yeah.
Those are online surveys, right?
They're all online surveys. Yep. But my experience thus far has been that those things like regime or level of economic development really dramatically affect the level. But as soon as you start looking at the trend, you can plot Russia on top of Europe and do a pretty direct country-to-country comparison.
I see. So what's the takeaway here? I mean, my interpretation of what you told us, 7% down less than a point from the peak. I don't come away
I'd
feeling
say
warm and
not out of
fuzzy.
not out of the woods yet. That's kind of my
I think we're still in the woods. It feels like to
correct.
me.
Yeah, still in the
Deep,
woods.
deep in the woods.
Yeah.
And the distribution. Okay, that's your somewhat pessimistic outlook, I guess, because feels like you need to have much higher rates to kind of much slower growth to kind of wring that out. That's kind of where you're coming down.
I don't know if they're fully unanchored, but it does feel like this period of higher inflation is ingrained in consumer psychology in a way that it wasn't a year ago.
That is interesting. Now the sentiment, the if you look at the Mish survey
Yep.
on inflation expectations, it paints a somewhat less dark picture, right?
Yeah, although they both, I mean, the New York Fed released something recently too. I think they're jumping around right now, and part of that is just the monthly release
Noise.
cycle. We're seeing, I mean, what we see is consistent with theirs in the sense that week over week, we're seeing a lot of more turning points than we saw 3 months ago.
Okay. Interesting. Okay. Let me ask you. We're getting a little late in the podcast here. I know you guys do so much interesting survey work, and actually, I'm sure you recall, but we did some work with you back.
Yeah, that was great. I really enjoyed that.
During the pandemic. Really found that very insightful work. I know you're working now on remote work perspectives. Can you just fill us in on that? That's the topic we've been talking a lot about on the podcast as well.
So I think there are two things. I mean, I should say this. I'm sitting at home right now, so that should be.
I am.
I mean, 3 out of 4 of us.
3 out of 4 of us. So,
yeah,
in the office.
So there are two things. So on the sort of the worker front, we have seen very, very strong evidence that folks who work from home, first of all, that their so-called burnout, their level of burnout is much, much lower. They report higher levels of job satisfaction, lower levels of work-related stress, even when you control for income, age, education, and occupation or industry, sorry. And the second is that there's some evidence that they also assign a fairly strong sort of financial value to having that flexibility and freedom to work from home. Again, even after controlling for all those sorts of factors. So I think it's hard to see a world where you could strip people of working from home and not compensate them in some way. That feels
baked.
It feels baked in at this point. And then, so that's part of it. The other part is we've started to run small business surveys as well. And so from Q3, we saw, I mean, overwhelming majority, I think 55-60% of small folks with 10 to 500 employees saying that they've operated in a hybrid work environment. It just feels in many, many ways that that's sort of how people are expecting to operate going forward. I don't think that economists have fully thought through all the spillover effects of the ways in which that changes people's purchasing patterns, commuting times, and all that sort of stuff.
Yeah, that's my sense. I think the game has changed meaningfully.
Yeah, this is why Chris is always grumpy. He's going into the office.
Yeah, you're right. Yeah,
the grumpy economist.
So
more productive.
Any insight into the question of productivity? I mean, to some degree, I guess that goes to if workers feel more relaxed and better about their work environment, they're going to be more productive. But I'm leaping. Is there any insight there?
We were running some survey questions asking people to compare their productivity to pre-pandemic periods, and that was showing that those folks who were working from home indicated that they were more productive than they were prior to the onset of the pandemic. But that data set, I think, just kind of became less and less trustworthy. As you know, it was very difficult to ask people 2 years after the fact to go describe how much work they were doing now compared to 2 years ago. That's not sound survey methodology. It is clear. I mean, that's something that Scott on my team and I talk about a lot. Of just those, the productivity numbers are terrible.
Yeah,
they're really, really bad. And so when you talk about wages, that's one thing. But if you start talking about unit labor costs, it's a different it's a different story.
Yeah. Okay. Well, we can go on and on and on, but since I've got you, one more thing. We
Yeah.
got these elections coming, right?
Yeah.
2 weeks, I think, less than 2 weeks. And I know you do a lot on the other side of the house. You do a lot of political survey work. Any insight there? Give us any. Can you handicap the election at all?
I wouldn't handicap it because I do think it's going to come down to a lot of these contested races. It's very clear that Biden's approval rating is much lower than it was a year ago. We've seen some bounce back at the national level. I think, well, what we all know is just how important it is to go look, race by race, district by district, and start breaking out that data. I should say in some of the states that are some of the most contested states, we've seen that people's views of the economy, at least, have fallen fairly dramatically relative to prior to the election in 2020. So there's case to be made there that sort of the economy is certainly a headwind to incumbents holding on to their seats in those battleground Senate seats.
Yeah. Okay. All right. I wanted to ask you one more thing. Oh, kind of an open-ended question. Because you are looking at a lot of different survey results. What survey result has surprised you the most recently? Like you said, oh my gosh, where did that come from? Anything interesting out there?
I think I'm interested. I think a lot of times it's making sense of the. We've done a labor hoarding survey. That was interesting. We
the what?
Labor hoarding.
Labor hoarding. Oh,
we
okay.
spoke with small business owners and tried to figure out to what extent they were holding on to workers, even if they didn't feel like the demand was there. Basically, it was a sort of a labor supply issue that was driving labor hoarding. With some, I think, fairly strong evidence, in fact, that there's evidence of labor hoarding. That's ours. I told you a little bit. We just ran an updated random control trial trying to understand the impact of wage expectations on inflation expectations.
Oh yeah. Right.
And for the first time, so we ran the first wave almost a year ago, and now we ran a second wave, and there's evidence of causality running from wage expectations to inflation expectations in a way that didn't exist before. It was strictly the inverse. And so you're starting to see now some evidence of this wage price spiral. That was surprising to me. I thought we had the first time we ran it was a 20% pass through. So basically people expect to be made 80% worse off for a given change in prices. They don't expect their wages are going to keep up with inflation.
Right. Okay. Well, that's a little disconcerting as well, because Ryan, your work has shown that it's inflation affects wages, but wages have not turned around and affect prices or inflation, at least so far.
Yeah. Yeah. And we were using the employment cost index and things like that to see it. So it's interesting work to look at inflation expectations and wage expectations. So, maybe that's the early warning sign that we're moving from a price wage spiral to a wage price spiral.
Be a problem.
Not a big problem.
Big problem. Yeah. Okay. You guys are making me depressed.
Sorry.
I need to go back on the road. I go visit Iceland or something. Well, John, I
35 ships, Mark. Remember
35. That was a really good one, Chris. That was
your
a good
day.
one. Yeah. That was the one positive news, I guess. John, I want to thank you for coming on. It was really
my pleasure.
Very thoughtful and interesting, and really appreciate your insight. This is a special podcast because this is Ryan's last podcast on Inside Economics, and I just want to say, no, I do. In all honesty, I'm being very earnest. I will miss you. Your insight, your thoughtfulness, your wit. I'll even go far as to say your trolling. Really added to this podcast. Made it what it is, and it's a success. We've done in a little over a year I think we've seen our listenership rise to a very significant degree. I get lots of great comments wherever I go. People are listening, and that, a lot of that success goes to you, Ryan. So
Thank you.
I want
And I'm
thank
going to miss you and Chris and so much. I can't tell you like how much this place means to me. It's hard, but just working with you guys for the last 17 years it's meant the world to me.
Yeah. All right. Chris, anything you want to say?
I still don't believe it.
You still don't believe it.
I haven't fully processed it. Yeah, it's
This
a
is your
tremendous
last
loss.
podcast, though, right? Am I right about that?
It is. This is my
It
last
is.
one.
Yeah. I mean, we do have Marissa joining, and we all.
Oh yeah,
love
you're in
Marissa.
really good hands.
We're
You
in
have
good
Marissa.
hands. We're
Yeah.
in good hands, but
You'll definitely be missed.
Thank you.
we're going to be
Big hole.
watching the ratings very carefully here. That's a message to Marissa. Marissa, we're
I
watching
told
the
Marissa,
ratings,
I was like,
Marissa.
you got to keep Mark in check.
That's exactly.
Passing the baton on to her.
And she's good at that, actually.
Yeah.
She's
But this
quite good.
podcast has been one of the highlights. It's every week I look forward to it.
Yeah, I really do as well. Well, thank you, Ryan. I really
Thanks,
appreciate
Ryan.
it. And
I'm
Thank
going to
you,
give you one
everyone.
last cowbell.
well, actually, we got all these cowbells with the three of us on the cowbell. We're sending
Yeah.
them to your home, all of them.
Okay.
You're going to have 10,000 cowbells.
That's perfect.
Yeah, on your front stoop.
Well, when my kids get sick, they want the bell. So when they're upstairs and they're like they need something, they ring the cowbell. So
Oh, is that
yeah.
right?
Repurposed.
Oh,
Nice.
that.
Nice.
Oh man, I nipped that one in the bud. Yeah.
yeah, that was a bad mistake on my part.
Yeah, bad mistake.
Yeah.
Okay, well, with that, we are going to call this a podcast. Thanks, everyone. Talk to you next week. Take care.